All right, today we are digging into PBF Energy's latest earnings call, and this one was a real head scratcher. You see, on the surface, the company actually beat expectations, but the market, whoa, it had a completely different reaction. So let's jump right in and unpack that disconnect to figure out what's really going on with PBF. Here's how we're going to break it down. We'll start with the market's weird reaction, then we'll go inside management's turnaround plan. After that, we'll look at the big picture trends they're hoping to ride, check on the health of their balance sheet, and then we'll wrap it all up with our official rating and what to watch for next time. So, first things first, let's tackle the big mystery. Why on earth did the market punish a stock that, at least based on the headline numbers, looked like it delivered a pretty decent quarter? Okay, let's look at the numbers. PBF posted an adjusted loss of $1.03 per share. Now, the analysts on Wall Street, they were expecting a loss of $1.19. So PBF actually did 16 cents better than expected. They beat on revenue, too. You know, on paper, that's a win. Simple as that. But this is where the story takes a sharp turn. On the day they announced these better-than-expected results, the stock got hammered, dropping a whopping 8.4%, and on some really heavy trading volume, too. The market saw something it did not like, and boy did it make its feelings known. So this brings us to the key question we need to answer today. What gives? What was hiding in the details that made investors hit the sell button so hard? Was it something about their operations? A hidden risk? Let's peel back the onion and look at what management is planning. To really get to the bottom of this, we need to dig into management's game plan. The company is dealing with some pretty big operational headaches right now, and their strategy really boils down to two main things: getting a super important facility back up and running, and cutting costs like there's no tomorrow. First up, the Martinez refinery. This is a huge deal. A fire took it partially offline, and that has been a major drag on their performance. Now, they did get some parts of it working again back in April, but the real prize, the thing everyone is waiting for, is the full restart. Management says they're aiming for the end of this year. You can bet the market is watching that timeline like a hawk. The second part of the plan is all internal. They've got this cost-cutting program they're calling the Refining Business Improvement Program, or RBI for short. And the goal here is absolutely massive. $350 million in annual savings by the end of 2026. This is their big lever to try and boost their profits for the long haul. So, where's all that cash going to come from? Well, a huge chunk of it, 70%, is coming straight from day-to-day operating expenses. The other 30% is from their capital and maintenance budgets. And management was really clear on the call. These aren't just one-time fixes. They're aiming for permanent, sustainable improvements. Okay, but it's not just about what they can control inside the company. PBF's leadership is also betting that some big, powerful forces out in the global market are about to shift in their favor. Think of these as the tailwinds they're hoping will give them a major boost. And you don't just have to take my word for it. The CEO, Matt Lucey, said it himself on the call. He expects the price difference between light crude oil and heavy crude oil to get wider. For a refiner like PBF, that's fantastic news. It basically means their raw materials get cheaper, and that profit goes straight to the bottom line. He literally called it a huge tailwind. And that's not all. They also see really strong global demand for products like diesel, partly because more refineries are shutting down around the world than are being built. On top of that, the market in California, a key area for them, is looking really good after some of their competitors shut down their own facilities. So a lot of outside factors could be lining up in their favor. All right, so having a big turnaround plan and some nice market wins at your back is great, but you absolutely need a strong financial foundation to make it all happen. So let's take a look at how PBF is managing its money to get through this tricky period. And they have been very, very busy. They managed to get a $250 million insurance payment for that Martinez fire. They're also selling off some extra terminals for another $175 million, and they're expecting a $70 million tax refund from the government. Each one of these is a pretty significant injection of cash. And what's the result of all that work? A very, very healthy cash position. At the end of the quarter, PBF had $2.3 billion in total liquidity. That is a massive cushion that gives them plenty of breathing room to fix the Martinez refinery and execute their plan without sweating the bills. Another key health metric we look at is net debt to capital. And PBF is sitting at 30%, which is comfortably below their own target of 35%. So the main takeaway here is pretty simple. Even with all the operational drama, the company's finances look really solid. All right, we've laid out all the pieces of the puzzle: the market's thumbs down verdict, management's game plan for a comeback, and the strong financial footing they're standing on. So now let's put it all together and figure out what this means going forward. Which brings us right back to our original question. Was that huge 8.4% drop an overreaction? Is there maybe an opportunity here for investors? Let's weigh the bull case against the bear case. The bull case is pretty straightforward. If they successfully restart Martinez, that's a game changer. The cost savings they're targeting are real and should stick. And those macro tailwinds are no joke. So that sell-off, it might just be a great entry point. Now the bear case, it's all about execution risk. Can they actually hit their year-end target for Martinez? And what if the global economy gets rocky and those tailwinds disappear? The market is clearly skeptical for a reason. So after weighing both sides, we're landing on a reading of outperform. We think the market got too focused on the short-term risk of the Martinez restart and basically ignored the powerful 1-2 punch of permanent cost savings and strong macro trends. It feels like the potential rewards here outweigh the risks that the sell-off has already priced in. So looking ahead, what should you watch for? We expect the stock to slowly climb higher as the company starts hitting its milestones. That initial drop looks like an overreaction. When they report Q3 results, the two things you absolutely want to listen for are 1. Concrete proof that the cost cuts are working, and 2. A very confident update on the pace of the Martinez rebuild. That's the evidence the market is waiting for. And finally, as always, we have to say it. This is not financial advice. This analysis is for informational purposes only, so please do your own research.